Hello, this is Ernest Burley Jr., your CIA, your cool insurance agent, back at you again with some more great information on insurance. I'm a licensed insurance agent with over 30 years experience in the industry and clients all across the country in various capacities. So whether it be auto insurance or homeowners insurance, life insurance, long-term care, disability, health insurance, business policies, church policies, condo renters, what have you, all those various areas of insurance across the country, we help out clients. Okay, so the purpose of this podcast is to educate you, to enlighten you, to empower you with clear, objective, and unbiased information so you can make good decisions for yourself and for your family and for your business, right? So we talk about business matters on the podcast too. So let's jump right on into it. Here's today's podcast. What is today's podcast about? It is about bonds versus insurance. What's the difference? So a bond versus an insurance policy, what is the difference? I would venture to say 95% of the people don't know what a bond is or what it does or how it differs from an insurance policy. There are big differences, but a lot of people get confused about it. They don't know exactly what it is. So today we're going to talk about it. We're going to just get it out there so you'll know exactly what a bond is and how it differs from insurance. There are some key and basic differences between the two. So let's hash it out right now, okay? So the first difference that I want to highlight between a bond and an insurance policy is that a bond is a three-party contract and an insurance policy is a two-party contract. So the three parties to a bond situation, we're going to talk about that. Three parties to a three-party contract, the three parties to the bond are, number one, the obligee. The obligee is basically the person that, or the business or the organization or the state that's requiring the bond. I don't want to get too technical, but that's what the person is called or the institution is called, the obligee, the person or institution or state that is requiring the bond. And now here's another tidbit of information. Normally a person is not going to get issued a bond unless someone or something is requiring a bond. You can't just say, well, I want to get a bond. The bond company is going to say, okay, who's requiring the bond? They want to know who's requiring it, okay? So yeah, the obligee is the person that's, or the organization or state or institution that is requiring the bond. The second party to a bond contract is the principal. And the principal is the person that is required to have the bond, right? That's the individual that's required to have the bond. Very easy. Now, the third party to the contract is the guarantor. So the guarantor is the surety. A lot of people say insurance company, and insurance companies are mainly companies that do issue bonds, but it's called a surety company. So surety, S-U-R-E-T-Y, surety. The surety company is the guarantor. And that's basically the company that issues the bond, right? So that's the three-party contract versus the insurance company is a two-party contract. It's just the insured and the insurance company. That's it. So you insure your auto policy, your vehicle, it's just you and the insurance company. You insure your home, it's just you and the insurance company. There's no third party in the mix that's requiring the policy and being party to that contract, okay? That's one big difference between the two. Another big difference is a bond is really a form of credit, okay? It protects the obligee, which remember the obligee is the person or institution or state requiring the bond. It protects the obligee by guaranteeing the payment of the principal. So saying, hey, we're guaranteeing, we're backing the principal saying, hey, they're going to fulfill their obligation. So it's a form of credit. It's a form of credit. Bonds do not anticipate paying losses. They do not. They don't anticipate paying any loss whatsoever. So if a surety company does end up paying a claim, if they end up paying out part of the bond claim or paying a bond claim, they will expect full reimbursement from the principal. That's another big difference we'll get into in just a few minutes. So yeah, a bond, if it's paid, they're going to be coming after you for the money to get the money back versus insurance. So here's the difference. So insurance companies, insurance is a policy that protects the insured against an insured loss, right? So insurance policies do expect to pay claims. Insurance policies expect to pay claims. And what they do is they pool the risk. It's called pooling the risk. So it's the law of large numbers. So you pool the risks with large numbers of people paying into the premium, paying premium into the pool. And as claims happen, they just pay claims out of that pool of money, right? And there are millions and millions of dollars being paid in claims every day. People don't think that, but I used to work in claims, so I know I've written a lot of checks, millions of dollars and millions and millions and millions of dollars of checks myself in claims. So claims do happen, and insurance companies anticipate that they will pay out in claims, but they don't ask for reimbursement. So if you go total your car, $20,000, $30,000, $40,000, or you burn down your house, $200,000, $300,000, $400,000, and they pay those claims, the insurance company is not coming back at you asking for that money back. So that's the big difference between a bond and an insurance policy. Insurance companies are not going to ask for the money back that they paid out. A bond company is, okay? Another thing you need to know about bonds, bonds are issued based on the ability of the principal to make the obligee whole in the event of a claim. So the principal is going to have to prove to the surety company, basically the guarantor, right? So the principal, the person who is required to have the bond, has to prove to the surety company that they have the assets to repay the surety company if they have to pay out on a claim or a loss, okay? So like I said before, bond companies, surety companies, they do not anticipate paying losses. They don't anticipate paying losses. They are basically like the front man. Basically, they just say, okay, we're guaranteeing this person or backing this person. And the way they kind of shore themselves up to hopefully not pay any claims, they only issue bonds to qualified individuals and qualified businesses who are required by a third party, so by an obligee, to have the bond, and they can prove they have assets to pay back any bond losses. So those three criteria, okay, qualified business and qualified individual has to be required by some third party, an obligee, to have that bond. And also they have to show they have assets to pay any bond losses that may occur. So if you have a $100,000 bond, they're going to want to see $100,000 in assets that you have. Okay, that's the way it goes there. A bond, it comes with a high level of financial scrutiny because a person can be denied a bond. You could be denied a bond, say if your financials aren't in order or you have challenged credit, bad credit. Yeah, you'll probably be denied a bond, right? Because yeah, it's a lot of financial scrutiny going on there. Now, that's another difference between a bond and an insurance policy. It's highly unlikely you'll be denied an insurance policy because your credit is poor or you have poor financials. Now, there is a credit component to insurance rates. So if you have challenged credit, more than likely you're going to have a higher insurance premium than someone who has better credit. They will have a lower premium on their homeowners or auto policy. So there is a rating factor involved with insurance policies that involves credit. But with a bond, it is very highly scrutinized. It's not as scrutinized as much on an insurance policy, but it does affect your rate. With a bond, it could affect your ability to even get the bond in the first place. So your credit, your financials have to be in order for you to qualify for a bond and to have a bond issued to you. Last but not least, bond premiums are paid to guarantee the principal will follow through on their obligation. Okay. So like I said before, like for the third or fourth time, they're not looking to pay out any claims or losses. Basically, they're charging a premium to say, okay, well, we're going to vouch for you. That's what it is. I mean, that's the slang term. They're vouching for the person. So they're charging the principal, the person required to have that bond, they're charging that person a premium to vouch for them. Say, okay, we're going to vouch for you. We're going to put up this, $10,000 or $50,000 or $20,000 and say, that's what you have to pay if something unfortunate happens. But they're going to come right at you to get that money back if they do have to end up paying out on the claim. So it's a fee. It's not anticipating paying any claims. It's a fee for vouching for the person, basically, right? Versus insurance premiums are designed to cover losses because those insurance policies are anticipating they're going to pay some claims, right? So they charge a premium based on, the amount of claims that they expect to pay out, right? So that's a big difference in the two. The premium for the bond, hey, we're just going to charge you a fee to vouch for you, basically, right? Because if we pay something out, we're coming back after you to get our money back. Versus the insurance policy is like, okay, we need to charge a premium because we expect a certain amount of people are going to have auto accidents. Certain amount of people are going to have their house burned down or blow away in a hurricane or tornado. Certain amount of people are going to have hailstorms, whatever, lawsuits, someone's going to slip and fall in their house. They anticipate those claims are going to happen, so they charge a premium for that. And they anticipate paying out losses versus bonds do not anticipate it. They're just charging a fee to vouch for you, right? That's it. That is it for the differences in the two. Those are like the main differences. So now you should be pretty clear about what a bond does versus what an insurance policy does and the main differences between the two. So here's our recap. Our recap is there are big differences between a bond and an insurance policy, as we've just outlined, right? A couple of takeaways. So the main takeaway I would think is, here's what a lot of people would want to know is that you must pay back any bond claims. So if a bond company pays out because of a claim, you're going to have to pay that money back. That's a big takeaway, right? And another takeaway is there's a lot of financial scrutiny around qualifying for a bond, right? So those are two big takeaways, even though we talked about a whole lot of other stuff that is very important also, right? So I want to thank y'all for listening. I really appreciate it. I thank you every week. Y'all listen in and tune in. And I appreciate the feedback. I get feedback every week. People email me and say, hey, that was great. Or, hey, did you think about this or think about that? Or what have you, or what do you think about doing a podcast on this, or maybe about a point on this? I love it. Thank you. I appreciate it. I appreciate y'all listening, and I do respond to emails. So email me if you want to reach out to me. Email me. My email address is ernestburleyjr@gmail.com. It's just my full name @gmail.com. So that's ERNESTBURLEYJR@gmail.com. Again, ERNESTBURLEYJR@gmail.com. Please spread the podcast to others and ask them to do the same, and so on and so on and so on, so we can get those podcasts out there in the stratosphere and the atmosphere, and make them go viral, because I think they're helpful. I think hopefully it's helping you out in various areas. Now, all of my podcasts are on YouTube, so you can go right to YouTube. I ask that you go to YouTube, subscribe to my channel there. It's just my name, Ernest Burley Jr. That's the name of my channel. If you subscribe and ask all of your friends, family, church members, co-workers, acquaintances to, hey, go check out this guy, Ernest Burley Jr., subscribe to his channel and check out the various podcasts he has on there. And also I have TikToks on there and 1-minute clips about various areas, not just insurance. We talk about real estate. We talk about business. We talk about excelling in your career and a whole lot of different things on the channel. All right. So that is it for today's podcast. I thank y'all for listening in and tuning in. I really appreciate it. And I look forward to continued podcasts to give you great information to make some great decisions for yourself, for your family, for your business. Okay. So, hey, this is Ernest Burley Jr., your CIA, your cool insurance agent, signing off. Until next time, y'all take care and be safe out there.